Good morning. It's Tuesday, the 19th of November, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming from Mumbai, India's financial capital. The take. In May this year, stockbroker CLSA put out a Modi stock portfolio listing 54 stocks it was betting on to ride the Modi wave when he returned to power, which he did, but clearly not in the way that CLSA or most of the stock markets expected. So CLSA revised that portfolio from 54 to just 2 stocks, being ONGC and Reliance Industries. In early September, it emerged that the so-called Modi stocks had risen only 2% as the government completed its first 100 days in office after that third-term win in June. In contrast, Bloomberg pointed out that consumer and software stocks rallied about 20 and 34% respectively. Over the weekend, CLSA was back trying to grab attention by putting out a report called Pouncing Tiger, Prevaricating Dragon, the meaning of which is not so clear to me, but must be to the authors. It said that CLSA was reversing its earlier tactical allocation shift from India to China that happened obviously late September. As a quick background, in October 2023, now this is a year ago, CLSA upgraded India from 40% underweight to 20% overweight, citing a favorable credit environment, lower energy costs thanks to discounted Russian crude and strong GDP growth prospects. A year later, or last month, that's October 24, CLSA reduced India's overweight to 10% while adding to China amidst what happened to be, or rather what appeared to be, early signs of a market recovery in China. Now, all of this is obviously independent of the Modi stocks proposition put out in May and more to do with the big exodus of foreign capital that happened starting September 27th and has now crossed over $13 billion. So the latest, just to go back to the weekend, is that CLSA has reversed its tactical allocation, returning to a benchmark on China and a 20% overweight in India. It says that both MSCI China and India have corrected by 10% in US dollar terms and that they did not lose making that switch. It further adds that the chief risk to Indian equities is a frenzy of issuances or IPOs swamping the market, with cumulative 12-month issuances being equal to about 1.5% of market capitalization, which is a tipping point. On that, I agree. So what's changed? Obviously, Donald Trump has changed, who has threatened to hit China with a 60% import tariff for all products into the United States. US imports from China were about $165 billion in 2023, lower than previous years, taking out the pandemic year, of course. India will get hit too, between 10 and 20%, depending on the promises made or threats issued so far. So which figure will hold end January when Trump formally takes over as president? Well, that's tough to say at this point. Remember, if all countries get hit, then the relative damage could be lower and countries like China are better prepared now. Anyway, a fresh report in Bloomberg yesterday points out that CLSA and Citi are now taking opposite stances on Indian equities. India is least likely to feel the heat from potentially higher Trump tariffs, and India offers a relative oasis of forex stability, and the recent stock declines have made valuations attractive, CLSA said. Citi, on the other hand, has downgraded Indian stocks, citing concerns about weaker earnings momentum. But then, in May this year, Citigroup downgraded Chinese equities to neutral and upgraded India to overweight, saying that they liked markets with inflecting earnings and strong EPS momentum. It would obviously take a lot of concentration to keep pace with these changes and shifts. On the other hand, almost everything we've just discussed so far is out of the window, which tells us a few things. One, no one is able to accurately predict anything beyond a few months, particularly when geopolitics is involved, and that is increasingly playing a role in our lives and stock prices. Most predictions are based around events and not a long-term view is perhaps the second takeaway. And if there was a long-term view on a sector or a company, which there could have been or would have been, it wouldn't matter either way because something else would happen and supersede it, as has been happening. And finally, stock analysts are human and can sometimes rush to make up for lost calls, including with fancy charts, which you and I are not good at. The good news is that Donald Trump is human too, and he might change his mind before the 20th of January 2025. And that brings us to the top stories. The markets on the longest losing streak since February 2023. Auto sales pick up in the festive period, but what is the final analysis? Can an escalation in trade tensions drive up gold prices? The stock markets might be down. How are real estate trends looking in contrast? And Indians migrating to OECD countries like the United States and United Kingdom are up 30% year on year.
This is a core report with Govindraj Ethiraj.
The market's on a losing streak. The Nifty has now notched its longest losing streak since February 2023, falling for the 7th consecutive session thanks to a sharp sell-off in IT and energy stocks on Monday. The Sensex swung again, as it usually does when sellers and buyers face off, swinging 900 points on the bosses. The Sensex fell about 241 points to close at 77,339. NSE Nifty 50 was down about 79 points at 23,453. The reasons for the weakness were broadly the same as before: slow earnings, continued selling by foreign portfolio investors, and of course, high valuation. On Wall Street, things have cooled off now, with the markets mixed overnight as Wall Street waited for major earnings reports. Tesla jumped 8% pre-market after Bloomberg News reported, citing sources, that President-elect Donald Trump's team is working on ways to ease regulation on self-driving vehicles, which of course is quite a jump from going from a situation where the Trump administration could have been against electric cars to allowing self-driving vehicles. All indices now on Wall Street are down as of last week, according to CNBC. Meanwhile, the only thing that's up, and sharply so, is air quality index levels in New Delhi. Hundreds of flights were delayed as a thick blanket of toxic smog swarmed over most parts of northern India and including Delhi. AQI readings were the worst in New Delhi this year, which of course goes to say that they are bad every year. Visibility dropped to about 100 meters in Delhi and Chandigarh, which is northwest of New Delhi, but authorities said that flights and trains continue to operate with delays, according to Reuters. Goldman says go for gold as trade tensions rise. Gold will rally to a record next year on central bank buying and US interest rate cuts, according to Goldman Sachs Group, which listed gold as amongst its top commodity trades for 2025 and said prices could extend gains during Trump's presidency, according to Bloomberg. Goldman analysts said go for gold, and they reiterated a target of about $3,000 an ounce by December 2025. Interestingly, Goldman says that there could be a higher structural demand from central banks, while a cyclical lift could come from flows to exchange-traded funds as the Federal Reserve cuts interest rates, they said. So gold, as we know, has hit successive records. Still, of course, Donald Trump won, and then a strong dollar took over. Now, the interesting view is that an escalation of trade tensions, this is the new angle, could revive a speculative positioning in gold. In addition, rising concerns over US fiscal sustainability may also aid prices, they said, noting that central banks, particularly those holding large US Treasury reserves, may opt to buy more of gold, according to Bloomberg. So gold was last quoting at about $2,584 an ounce after hitting $2,790 an ounce last month. Oil prices to hold steady. Brent crude is seen now trading between $70 and $85 a barrel next year, although there is a near-term upside risk if the Trump administration clamps down on flows from Iran, according to analysts. Base metals were favored over ferrous, and European gas faced upside risks in the short term from the weather, according to analysts who spoke to Bloomberg. The new US administration further raises the risks to Iran's supply, the analysts said, citing scope for potentially tighter enforcement of sanctions in a maximum pressure campaign. So where did auto sales land? The main festival season, around which most major sales of discretionary items and purchases happen, has mostly ended. Now, this is a 42-day period, which one can measure year on year, and we'll come to that shortly. Because of some variations within that, there was some confusion about whether the overall sales numbers were holding up on an annualized basis or not. But the latest numbers are, of course, encouraging. Total vehicle retail sales in India were up about 32% year on year to October, with both two-wheeler and car sales growing sharply, according to the Federation of Automobile Dealers Association. Passenger car sales, on the other hand, were up about 32% compared to October 2023, and two-wheelers were up about 36%, three-wheelers were up about 11%. And what is all this adding up to? Because despite the strong sales performance, FADA has raised concerns about high inventory levels in the passenger vehicle segment. Dealer inventory is still about 75 to 80 days, despite a slight reduction now of about 5 days. And the oversupply situation could lead, of course, to more discounts towards the end of the calendar year, which is good news if you're a consumer. To understand where things were right now, I reached out to FADA Chairman of Academy and Research, Manish Singhania, and I began by asking him how he was seeing overall sales and the outlook for the rest of 2024.
The total market has evolved. Definitely the initial expectation that post-COVID and post-BS4 to BS6 price transition, things in rural market were taking time to settle down. And the recovery of rural market was due. We were expecting in, 3-4 years post-COVID, we will see the revival of rural market. But now what has happened, the rural market has now started delivering numbers. rather than the rural market banking on the entry level passenger car, their aspiration to buy a better vehicle, more safer vehicle, more feature oriented vehicle, a larger vehicle, that's the space that the rural market has now entered into. And that's why we can see, even though retails are happening in rural market, but the same is not being heavily reflected on the entry level passenger car numbers. The choice of the customer has changed, has evolved. I think this is one of the most primary factor. If you look at the two-wheeler segment, it is really rocking. All two-wheeler numbers are delivering well. The growth is almost every time in double digit now. So there is no question of rural market not evolving. Also, the ever increasing MSP, minimum support price by the central government to the crops, that has also increased in the heavy cash flow in the rural India. This year itself, kind of increased MSP will result in an additional cash flow of almost 25,000 crore for the crop industry itself. So I think the customer preference, customer demand or requirement has changed, and it is now more towards the SUV space, feature oriented, safe vehicles. So that's why probably Maruti or the sedan segment companies are not seeing the numbers really happening there.
Just to recap, you're saying that the rural consumer, particularly for cars, is now more aspirational than the urban consumer on a relative basis?
Yeah, definitely. If you look at both at the two-wheeler as well as the passenger car segment, the same story is happening. The more premium product, the better is the, you can see in the terms of booking, you can see in terms of retail. If you look at the price bracket of passenger car of 10 lakh plus, that segment itself is rocking. Every year, every month, we are seeing a steady growth. We were expecting there has to be some kind of a stop there. It continues to grow. The penetration of SUV continues to grow every month.
Right. So if you were to take, let's say, 100 cars sold by a dealership like you, so what would it have been in the lower end before, let's say, a year ago, and what is it today?
The real story is that 60% is being now occupied by SUVs. That is very clear. And rest is divided amongst the entry level sedans and likes. Majorly, we should not forget that the taxi aggregators, these are also a major buyer. And CNG is playing a major role in, for the numbers to keep rolling in these segments. So that's a segment that has been kind of moving and growing. But overall, if you look at the passenger car personal segment for individual users. So that segment is not moving much.
Right. So now to come to the festival season, now I think festival season is over because we had some, let's say, confusion about the calculation because the exact dates were different from the previous year and so on. So if you were to now look at the entire festival season, how has that fared compared to last year?
See, we should not forget that last festival season we had already created a huge, mountain of records. This festival season we were able to surpass it. That's a phenomenal number. And at FADA, we do not calculate on a month. We definitely give the data on a month to month basis, but if you want, we also calculate the 42-day festive period. That is start of Navratra to 10 days after Diwali, because Vahan numbers need to settle down. Various states work in various ways, so Vahan numbers need to settle down, and that's how we come up from exact festival to festival. If you compare festival to festival numbers, the passenger car segment has grown. It is still clocking good numbers, almost 6-7% growth was there. I'll share you the press release that we had given out for the festival period. So I think the segment continues to move, and there are two segments which are now clearly available at the dealership level. There are models which were not commanding any waiting and all that, X shelf, off the shelf, and good schemes for the consumer schemes for the consumers. But there were few models with every OEM which continued to command waiting period, and they were not available off the shelf. So that clearly shows there is a still a kind of certain percentage of growth that can still happen in the passenger car segment, since the booking continues to, for especially for the SUV segment, the booking continues.
Right. Yeah. And we have seen that in some models where there are still very long waiting periods. And finally, the overall inventory levels have still not really gone down. From what I could see from the official release, FADA is still talking about 75 to 80 days. So how is that looking?
See, inventory level will not go down in 1 month. OEM should understand the true situation. In spite of such a rocking festival, dealers continue to be saddled with heavy inventory. They need to take it again into, they are the people who need to act for continuous 3 or 4 months. The dispatches has to be lower than the retail. Then only the inventory level would be at a comfortable level. Similar situation was there last year, and OEM took into account of the high inventory level and they reduced it. But February, March, we had come down to inventory level of almost 45, 50 days. But again, the inventory level were pushed up. So it is right time. We are approaching year end, and year end offers are always there now since these stocks are available at the dealership. So I think it is the right time for OEMs to correct the inventory and bring dealership stock at a comfortable level.
Manish, thank you so much for joining me. How is real estate contrasting with the stock markets? Now, Mumbai is the key driver for India's overall real estate market with the highest value deals and total value as well. To pick on some data points, property consultant Anurag's latest compilation of data shows a decline of about 13% quarter on quarter and 6% year on year, but this is July to September. For a country as a whole, sales had fallen 11% during that same period, that's July to September, according to Anurag, with the top 7 cities seeing a 19% drop in new housing supply. But the larger question here is whether there is a sync between stock markets and real estate markets. Now, they do not move in tandem usually, but there is sometimes, or rather oftentimes, a lag connection. And is there any impact from those recent corrections we've seen in the stock markets, even in sentiment? I reached out to Dhaval Ajmera of Ajmera Realty and Infra, a listed stock company in the realty space in Mumbai. The more than 50-year-old Ajmera operates predominantly in the mid-market space in Mumbai in housing and occasionally in the premium space as well. And I began by asking him how he was seeing the market right now.
So basically, just to give you a oversense, I think the real estate market is honestly post-COVID really well. There had been a great jump, I would say, immediately post-COVID because people really realized the importance of home. Real estate is, moving in a very positive sign. There has not been very great jumps like, today the stock market moved maybe 10% or next month it was double. Real estate has not moved like that. It's moving steadily up. And that is where we are seeing a great movement happening. There has been a great sales all across. And my feeling is this will continue because Indian economy is also looking at a steady rise over the next few years.
Tell us about your book right now in terms of the projects that you have on hand and where are they located or which parts of the country and Mumbai city, which is where you are prominently, and what's the kind of demand that you've been seeing again in recent months?
So we've been in this business since about 55 years. We've delivered about 45,000 apartments. And now moving forward, we have about 1 million square feet of projects which are currently going on, primarily more in Bombay. We have another 4,500 crores of project coming up in the next 6 to 8 months time, which will be also launched by about 6 or 7 different projects. Majority of them are in Mumbai, but there is 1 or 2 in Bangalore as well. And we are also having another land bank with us, which is about 12 million square feet, which is available with us. So it's about 1.2 crore square feet of carpet FSI available, majorly in Bombay. So that's how our order books are going to. And those 1.2 crore square feet will slowly and steadily start coming into the books as and how things clear out in terms of approvals, etc.
And how are you seeing demand and at what segments are you seeing more demand right now?
So overall, if we look at our projects and when we specifically look, when what we've experienced, where we are more in Mumbai and Bangalore, our sense is mid-luxury, and in Mumbai, primarily luxury and mid-luxury doing really, really well. And if I have to look at Bangalore per se, is also mid-luxury in the Bangalore market perspective, I would say. So those are the kind of places where we are seeing good demand. So when I say that, we are looking at a pocket ticket size of about 2 crores to 4 crores in Mumbai. And Bangalore would be about 1 crore.
Right. And if I can ask you a cost question, how have costs been moving in the last couple of years? And I mean all raw materials, including land, which is obviously the dominant part of it.
So cost has been rising, and there is no two doubt about it that it's not been there. It was recently, in fact, there was an article that overall about 11% cost has risen in last 1 or 2 years time. And it's primarily because there has been sometimes labor issues, sometimes raw material issues, and stuff like that. Thankfully, a lot of these materials have now been produced in India, have been manufactured in India, so we are not having so much trouble or dependency on China. Maybe some finishing items here and there would be available or from China, but majority, I would say 80-90% is coming within India, so that is a good part. But yes, there has been a cost rise, and that it's basis through the inflation and demand supply. So cost is slowly rising, but overall, I think with that there has also been a steady price rise and not a very great jump, significantly coming up. So that way, it is being absorbed in the market.
What's the kind of profile of people who are buying and booking your projects, Dhaval? So, for example, we've seen NRIs participate quite heavily in some projects in Delhi or other parts of the country as well. And does that matter at all? I mean, rather, who is investing and in what intensity?
Every project has a very different thing. So if I have to look at our own projects, I'm just giving you some examples. Like let's say one of our Juhu project, which is a very high end and a very luxury project. They all will be business segment guys where they have their own businesses and they've been very successful in their lives. If I look at Vadala project of ours, which is mid luxury project, over there we'll have a mixture of business and professionals who are at the senior level. When we look at a project which is in Bandung, those are all service class people. So like basically who have been working and doing like that. And Bangalore also is primarily a lot into working. So the price bracket and the area depends a lot. But majorly I see demand in all three segments. Affordable, I think mid luxury, super luxury, and I would not say affordable, but which is tangible with public, which is like a senior level guy. I think that's the market which is doing really well.
We've, of course, been seeing data that affordable housing has been slowing down, including because of the challenge in accessing loans for those people. Now, is that a concern for you at all, or are you not really in that segment anymore?
We are not currently, but we would love to. And I think if there are a few changes which we as an association, CREDI, has been pushing the government to really look into this, and I'm hopeful that some things will come into order. The affordable driver or the affordable definition which is being currently there, which says that you have to have an apartment size of 45 square meters to 60 square meters or 45 lakhs, whichever is lower. Now, a 45 lakh apartment in Mumbai or, let's say in MMR or let's say Bangalore or primary Delhi will not be possible. House and affordable housing is supposed to be linked to the size of the apartment and not price of the apartment. If we just change that definition, I think 60-70% of our real estate market will come into the affordable bracket, which will in turn change a lot of cycle in the real estate, because directly indirectly real estate contributes to one third of the GDP, and with that growth being phenomenally high, and this definition will dramatically change the demand supply for real estate.
And that's because of access to lower interest rate loans and or something else.
Absolutely. Access to lower interest loans, GST benefits, which the customer will get. As a developer, probably will get income tax benefits and stuff like that. So it's overall making the cost lower, and there has been enough and more demand. So always, I feel definition of any affordable housing or any other houses should be on the size, because a luxury house will always be 1,000 square feet or a 1,500 square feet or a 2,000 square feet. It cannot be 500 square feet or 600 square feet. And it should be, that's the size which, all of us, maybe I'm living in Bangalore, I'm living in Mumbai, I'm living in Gurgaon, or wherever I stay, that's the size of the apartment which I'm looking at.
A lot of people feel concerned always about quality of infrastructure in Mumbai. I mean, what's your general sense on how infrastructure, when I may say infrastructure, I mean public infrastructure, is keeping pace with the ambitions of companies and groups like yours?
So if you historically look how Bangalore, Hyderabad, Chennai, Gurgaon has developed over the last 15-20 years, is primarily because there was a great infrastructure which was possible and which was done. And that is why, and obviously IT sector moved in, and then the boom of real estate and the demand over there, public really started. Mumbai was struggling to this in infrastructure terms over the last few years. But if you now look over the last 5 years, it has been a dramatic shift in terms of the coastal road, in terms of the metros, in monorails, the expressways, the freeways. I think it's just making the entire suburb come together and become nearer to each other. And that is why we are seeing a lot of real estate development significantly taking place in every suburb of Mumbai. So be it Malad, be it Andheri, be it Bandra, be it Worli, be it wherever. That is the whole reason, because today, if I have to go to, probably from Worli, if I have to go to airport, I would probably take 45 minutes. But now, thanks to the metro, I'll reach in 15 minutes. So that's the dramatic shift. Now, coastal road has, significantly changed a lot of things. So I personally believe that infrastructure has a very, very big role in the growth of real estate, and vice versa, and for the city as well. So with this infrastructure growth happening, I think Mumbai is poised to look at, a significant rise in real estate in the coming years.
When you say metro, I'm assuming you mean the metro that will start in March next year.
Yeah, I mean, every metro. So, like, just example. So, even if you take an example of the current metros, like, from Andheri to Malad and all the way the highway, which has actually started. Today, I have a lot of people from my office. In fact, one of our managing director, he travels in metro because it is easier for him, and it saves a lot of time, because he stays in Ghatkopar in the suburb and he comes to Andheri to our office. It is taking him 40 minutes to actually reach from door to door, whereas if he travels by car, it's 1.5 hour to 1 hour, 15 minutes to 1.5 hour. So it really makes sense of, and a lot of our people who've been working with us staying in Borivali or Kondivali, it is easier for them to travel in metro rather than going in car. So it is dramatically changing the lifestyle. And I believe in next 5 years, probably, all of us would probably take a metro, like how people do it in London or New York. And that's how it's going to happen.
Dhaval, it was a pleasure talking to you. Thank you so much for joining me.
Thank you. Pleasure talking to you too. Take care.
Record Indians migrate. A record 560,000 Indians migrated to the Organization for Economic Cooperation and Development countries in 2022, a jump of more than 30% compared to previous year, according to reports, including in the Business Standard. The top three destinations for Indian migrants were the United States, United Kingdom, and Canada. That rise in migration represents nearly 8% of all migration flows to OECD nations in 2022, excluding humanitarian migrants, according to the 2024 OECD migration report. India leads now as the top source of new migrants, with China following second at 320,000. India made up 6.4% of all new immigrants to OECD. China was about 3.8%. Now, OECD includes about 38 countries, and those include the United States, Canada, Germany, Japan, the UK, Australia, and these are obviously all developed economies. Meanwhile, the number of Indian students at US colleges has gone up by 23% in the last academic year, overtaking China to become the top sender of international students for the first time since 2009 and driving enrollment to an all-time high, according to reports. India sent 331,000 students to study in US colleges in the 23-24 school year, according to Open Doors data from the Institute of International Education quoted by Business Standard. Overall, the number of foreign students rose 7% to about 1.1 million, which now surpasses the all-time high just set before the pandemic. China's contribution is actually down 4%, even as India's have risen. International students usually pay full fare for attending US colleges, which means they do not really get any scholarships or concessions. And they make up about 6% of the total US higher education population and contribute to about $50 billion to the US economy in 2023, according to the US Department of Commerce. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.